Welcome to the Finance Files, a podcast hosted by best friends Brittany Carter and Whitney Coford, with occasional appearances from Whit's dad, Greg Coford, and other guests.
We talk about all things finance, including investing, trading, economics, capital markets, and business management. Learn the investor mindset with us.
Disclaimer, this podcast is not investment advice. This is purely for entertainment purposes. Please do your research before making any investment decision.
We're your hosts. I'm Whit.
I'm Brit.
And we're here with the Greg Coford. And on this Fundamental Friday, we're going to wrap up our week about diversification.
Yeah, so I think we pulled out a lot of terms, right? And I think we can start going down, like, even, for example, bonds, there's a plethora of different types. But I think the purpose of Fundamental Fridays is, like, let's just go through some of the base pieces, and so that people can better understand, okay, like, what is a bond versus a stock, right? So a stock is going to be, you own a certain percentage of a company. So, like, when you buy Facebook stock, you now own a certain percentage of the Facebook stock. And the way, as an investor, that you're going to make money on that is you can either sell that stock at a future date, which will hopefully you'll sell it for more money because that company has grown, or you can, some companies actually offer dividends. So that means when they hit like a certain earnings, they will give you a percentage of their earnings to, like, you get that as money, right? So there's kind of two different ways to get that through the stock, and when you research a company, they'll tell you if they have dividends, or you can also look at the stock. And then the other kind of base element with that stock is, why is the price rising? And typically the market cap, like the general, like, price of that stock is going to be dictated on the performance of that company and how profitable it is, and how, like, based on that industry as a whole, there will be kind of like standardized multiples of their profitability that will dictate how much that stock is worth. But rather than getting to a bunch of equations, the fact of the matter is, if you think that company is going to be worth more money in the future, then the stock price is going to in turn increase. If you think that company is going to be worth less in the future, then the stock price will likely decrease. So that's kind of how stocks work. And then when you get into bonds, bonds are going to be lower risk than stock because they are quote unquote guaranteed. There's differences between the different types of stocks, bonds rather. But these are kind of a fixed, that's when Greg mentioned, fixed income assets. These are very secure investments. They're essentially like a contract, like a loan per se, that you're going to pay back. And those come from both the government, and there's also corporate bonds, which would be coming from a company. If you believe in the security of the U.S. government, then you're generally going to assume that the U.S. bonds are more secure. However, there are some large, very secure and stable corporations that do have bonds that can be beneficial. So that's kind of a stocks versus bonds piece. I'm curious, Greg, like, what are some of the ways that you kind of, because we can slice this so many different ways, what are some ways that you think about diversification in terms of asset allocation or different classes?
Well, you've got, as you've talked about, you've got stocks, you've got bonds, you have derivatives. These are securities that are dependent upon the price of another security, such as a call option, a put option, a convertible note, a forward, a future, those kind of things. And those can be used.
Greg, we're not letting you off that easy. We're not letting you off that easy. You need to explain what you just said, because you just threw out like 10 different financial terms that, like, the majority of Americans or any people know anything about. So if you want to,
I will say Rufus perked his head up at this, so he's very interested to learn more. He's a derivatives guy.
Yeah. All right. So derivatives, again, to reiterate, it's a security which its value is dependent upon another security. So, the one thing that most people would be likely familiar with is a call option. In other words, an option to buy a stock by a certain date in the future at a fixed price. Be similar to if you did an option on a house or a piece of real estate. You don't have to buy it, you just have the right to buy it. And if the stock goes up in value, then the option goes up in value. Um, a put is the inverse of that. It's the right to sell a stock at a predetermined price by a fixed date. So if you want either some insurance, you can buy a put, and then if your stock goes down, you make some money on the put. Or if you think a stock's going to go down, you could just buy the put, and if the stock goes down, you make money.
What if you want to
Um,
like exercise your right to buy? Is that like who issued that to where you can for sure buy? Are you buying that from the company? Did someone sell you this put? Like what was that like that holds the stock?
so
Like
so so the options that most people would be have access to would be options that are exchange traded, and so it'd be through your broker. So if you bought a call option on Apple and you decided to exercise that, you'd tell your broker to exercise it. And that what they would do is you'd have to have enough cash in the account. They would notify the exchange clearing corp that you're exercising that option. They'd send the cash. The other party would then have to send the stock.
okay, so it's another party that is holding the stock says, "Hey, we'll do this call option."
Or they just are speculating, thinking the stock's not going to go up and they can sell a call option and they're hoping it's going to expire worthless.
So
They
what
don't
is
have to own the.
what's the benefit to saying, "Hey, I own 10 shares, 100 shares of Apple stock, and I'll do this trade where you have a call option on my stock." What's the benefit to
So,
that?
so if you, in that case, it would be called a covered call because you're selling options on a stock you already own. And most people do that for extra income. In other words, if you say, oh, I would probably sell Apple if we're up 15% from where it is right now. So I'll sell a call option with a price up 15%. If the stock doesn't go up, I get to keep that money. And if it goes up, well, I was going to sell it at that price anyway. And if the
Why
stock
would someone
stays,
buy that? Why would someone buy for 15% more?
well, because they're speculating that it's going to go up.
But why wouldn't they just buy on the market for what the rate is now? Why would they buy it for 15% more? Is this more for like companies
So,
like,
so a call option sells for a fraction of what the stock sells for.
okay.
So by buying a call option, you may be able to buy that call option for a couple of dollars.
I see. So then you can use your money and put it in other investments in the interim.
Yeah, yeah, yeah.
Okay. And
And
so
so
you're
and so you get, so options give you the opportunity to highly leverage, but they're also very risky. And the vast majority of options traded on the exchanges expire worthless. And with the advent of 0 day option, in other words, options that are expiring today, that the amount of options that are expiring worthless has gone up even higher. So most people speculating in options are losing money, and the
well,
the market makers selling the options are making money.
Wow, shocking. The market makers invented an instrument that makes them more money.
Yeah.
Breaking news.
Yes.
well, so that's funny too. You actually use the word speculating. This is almost getting into more speculative, like being a speculator, right? Like I think that I don't know, I've always and I'm curious, Greg, because you're obviously like more involved in day-to-day like market things. Like I've just never been very interested in any sorts of like shorts or call. Like I've never explored that space extensively because I kind of am just more on the side of like value-based investing of, hey, I want to look at like, do I think this company is going to be worth more in the future? Do you think that there's like a certain type of person that would like that makes sense? Like they're not an investment banker or what have you, right? That they would want to actively be looking at this type of investing, or do you think this is like a very niche, like you're working in an investment fund or you're a day trader, like that's your space. Like, would you recommend this for the standard investor?
Well, for the standard investor, if you're not going to spend multiple hours a day studying the market, the answer is no. I wouldn't look at options. I do spend multiple hours a day looking at the market, and I'm in the middle of derivatives and option trading daily. So
So, going back to kind of our average investor and those looking to learn the investor mindset, earlier this week we talked about if you're just starting out with investing, one of the best ways to diversify is, buy the S&P 500 or pick an index fund, right? So let's talk more about what is an index fund and how can you pick one that fits your goals.
so an index fund is a fund that owns the index that it's specifying. In other words, an S&P 500 index would own the 500 stocks in the S&P 500 in the correct proportions so that the return of the fund matches the index return. That's the objective of the fund. And so what'll happen is as the fund gets more money invested in it, it'll buy more stocks. If people do a redemption, then they'll sell those stocks. Their job is to stay fully invested in the S&P 500 given the amount of cash they've been handed to invest. And so that's what they do. And you can get that on a myriad of indexes. There's a NASDAQ index you can do it on. There's a broad-based index on smaller stocks called the Russell 2000. I mean, there's all the Dow Jones index.
Emerging markets index, we talked about that one in our week on retirement.
Yeah, so there's all kinds of indexes, and there's indexes that you can also get on bonds. You can get, and there's also money market funds, and money market funds are tantamount to a savings account, except they're not lending the money out like a bank does. They're investing in fixed income. And so what they'll do is they'll say, oh, we're going to buy an array of treasury bills, we're going to buy some notes, we're going to buy some bonds. And then their job is to never let the value of the fund go below $1, so that your dollar is always worth $1. And the only question is, what's the return on the dollar?
Or the return of your dollar.
Yeah, that's their job, is to make sure the return is of the dollar.
Okay.
So,
and
and there have been times in the past when some money market funds have broken the dollar, so to speak.
That's where I was going. So yeah, is there a risk that an index fund that you invest in could, I guess, screw up?
So index funds are typically rebalanced every couple of months or quarterly, semi-annually, whatever is specified, they will do that. And so what happens, the people that, the wizards that define the S&P 500, what they'll do is they'll look at that and they'll say, oh, this stock in this given industry, this stock isn't doing very well, or they've diversified to where they're not really a good member of that industry. So let's yank them out of the index and put this other stock in the index. And so they're constantly looking at that and periodically rebalancing.
Are the money market funds though, where they're focused exclusively on bonds and notes, are those fixed, or are they also constantly like reallocate? Like, are they using a plethora of bonds and once it hits X date, they're allocating that money elsewhere, or like how does that typically work?
Well, yeah, because what'll happen is they'll always have a significant chunk in treasury bills. And those are maturing 30, 60, 90 days. So as those mature, they're constantly rolling those over into something else. Generally, they're rolling those over into more treasury bills, but they'll also own some medium and some longer term stuff because they know not everybody's going to want their money back from the fund all in one day. And typically, the longer the maturity date, the higher the interest rate. And so it's a balancing act for them because they don't want to run out of cash if there's redemptions, but they're trying to goose the return because the more money they're paying the money market fund holders, the more money they get to then in turn invest. And they're taking a spread on all that. And so they want to have as much money in the fund as possible because that's how they make the most money.
And that's an important thing to look at is how is the other side making their money or how do they make the most money? Because that's going to clue you into what is their goal.
Right, right. And what'll happen a lot of times is people will get pitched by independent financial advisors. Oh, yeah, we'll do this, we'll do that. And they charge an investment fee on top of what happens. I know of one individual who they have them in a mixed portfolio of stocks and bonds. And as you would imagine, as the market goes up, as the stock market goes up, that portfolio is going to underperform the market because the bonds don't go up as much as the stock. And there's a significant portion of the portfolio. But what they do when the market's going up is all their reports focus on the equity portion of the portfolio relative to the S&P 500. They don't talk about the overall return, including the bonds. Now, when the market's going down, that portfolio is not going to go down as fast as the market because of the bonds aren't going to go down as much as stock. So when the market's going down, all the reports talk about the return of the whole portfolio relative to the S&P 500.
Well, I think you just are touching on something really important, Greg, is like when you're talking about, you're like, oh yeah, most of the billionaires that are like 80 years old are predominantly fixed income, which are these bonds, because they're focused on less volatility. So, like the general principle you should always know is the higher risk, the higher return, but also the higher like potential losses, right? So you want to not only look at diversification, but also asset allocation, where, hey, if you're close to retirement, maybe you're putting more money in bonds. Yes, you're not going to have the same level of wins, but you're also not going to end up on the street come your retirement age.
Right.
Would you call that the manager that you were just talking about, would you consider that to be a predator of
No,
sorts? Oh, okay.
because they're not looking to. I mean, they're just looking to make their couple of percent management fee,
Yeah.
which
Well,
isn't going to destroy somebody's financial
I
well-being.
well,
Okay.
actually, though, I will somewhat disagree in that I don't think any, and Greg, I feel free to disagree with me here. I don't think anyone should be going with a like anyone that's taking a management fee, because when you look at the returns over like several decades, you're going to lose like hundreds of thousands of dollars paying a percentage to this person versus like if you just have a fixed advisory fee.
And philosophically, Brittany, I agree with you. However, some people like the comfort of having a quote unquote expert at their call, and they can talk about, oh yeah, I was speaking with my investment advisor the other day, and they just like that image and that persona.
Well, and
So
that's why I was like, we need this podcast because there needs to be like an unbiased place where people can come for information. So, although we
well,
are
but it,
not financial advisors,
yeah.
this
Well,
this
but if somebody wants to pay for this advice, you might want to set it up so they could send us money if they felt inclined.
we'll start a Patreon. We're like, okay, who wants advice from Greg? You only have to pay this much per month. He'll send you personal advice.
But really though, I think too, I just want to touch on this because I do think like if you look, if you decide to go some other percent, there are financial advisors that just go on a fixed fee. I also think it's important to find one that actually has a fiduciary duty, like legally, and this is actually something that's come up in certain like as part of certain election things is like some financial advisors do not have a fiduciary duty to work in your best interest, and there's been cases where like Goldman Sachs and some of these groups have actually gotten in trouble for like very predatory practices that benefit themselves versus you as an individual. So I do think there's just an important like yes, diversify, but also look at like how you're doing that diversification. Is it through like a fixed fee? Is it through a broker? Like like what's I think we brought this up earlier is like what's their financial interest, right? And make sure that it's
Yeah,
serving you at the end of the day.
yeah.
And I
And if you want to talk to somebody every week or every day or whatever, uh, understand you're paying for that.
which
And if
is
that's
fair.
what you
You're
like
paying
and
for
you're
their
willing to
time.
pay, that it is what it is.
Cool. Well, we've talked about diversification. Definitely diversify, whether it's across industries, geographies. Index funds are just the easy way to quickly diversify. Do you have anything else to add in summary, Whit and Greg?
You can also diversify your garden. So look at your whole life. How can you diversify?
Yes. How can you diversify your life? Perfect. Love it.
All right. Well, thanks for joining us for another week on the Finance Files, and we'll see you next week.